All right. Looks like it's about 2 after. We like to keep things on time and on schedule. So I know we've allocated about an hour for today's session. But I want to kick things off and say I'd like to welcome all of you to the second edition of Green Tiger Markets Learning Academy. My name is Knorring. I am the CEO of Green Tiger Markets, and we'll be hosting today's presentation. I'm joined by my esteemed colleagues, Oliver Pearson, Green Tiger Markets Head of Asia Pacific, and Alexis Hoven, Green Tiger Markets Head of Market Operations. So in our first session, our inaugural session hosted by Oliver Pearson, we discussed the basics of the ISDA framework. Today's session will be the first in a series of workshops called Hedging 101. Over the coming months, we anticipate holding additional sessions that build on some of the foundations that we are laying today. So let's get cracking. The course objectives of the Hedging 101 series of workshops, essentially upon completion of Hedging 101, you will be able to understand the different types of risks that electricity companies face. You'll be able to identify the appropriate hedging strategies to manage these risks. You'll be able to implement and manage hedging strategies effectively and evaluate the performance of the hedging strategies that you implement. So today we'll embark on a journey to understand how businesses navigate the complex world of risk management. We aim to make it as simple as possible. So we'll start off with an introduction to hedging. We'll move on to discuss some of the fundamental concepts of hedging. We'll go a little more in depth into some of the varied financial instruments that are available to hedge a variety of commodity products, as well as the tools available on the Green Tiger Markets platform. We will discuss a framework that your firm can use as the basis of a hedging strategy. And we hope to have time for an interactive question and answer session. So on the topic of questions, please don't hesitate to ask them during the presentation. Feel free to type your question into the group chat or to Oliver Pearson. And we will do our best to answer any questions along the way. But please, this is intended to be interactive. So if there are questions, don't hesitate to raise your hand or type something into the chat. So let's get to it. So what is hedging? We have defined hedging as a strategy used to offset potential losses or gains in one investment by making another investment. So I'll say that again. A strategy used to offset potential losses or gains in one investment by making another investment. Hedging allows your firm to gain greater certainty over its future. So why bother hedging? The primary purpose of hedging is risk management. Risk, in financial terms, is the possibility of experiencing losses due to market movements. Different types of risks include currency risk, interest rate risk, and commodity price risk. We'll spend most of our time today discussing commodity price risk, but it's worthwhile pointing out that other risks do exist. Currency risk and interest rates being some of them, as well as environmental risk, weather risk, or operational risk. But the areas that are inherently hedgeable in financial markets include currency risk, interest rate risk, and commodity price risk. So currency risk or exchange rate risk arises from the changes in the value of one currency against another. If you're a business dealing in multiple currencies, this risk can significantly impact your profitability. If you're an importer and you're buying dollar-denominated oil or dollar-denominated coal, if the USD PHP rate moves, you are exposed to that. So next we have interest rate risk. This is the risk that changes in interest rates will affect the value of financial assets or liabilities. And a good example of this would be a loan with a variable interest rate. A rise in rates could increase your repayments. And lastly, we have commodity price risk, and this is associated with the price fluctuations in raw materials like oil, metals, agricultural products, and electricity. Businesses that depend on these commodities often use hedging to lock in their prices and manage their cost structure. In the case of the Philippines electricity industry, the price of electricity is a commodity, as well as the fuels associated with the generation of electricity, like coal, natural gas, and diesel.
Anybody out there?
So why should I be hedging? The primary purpose of hedging is risk management. It's not about making profits, but about providing stability and predictability to financial operations. Businesses hedge to stabilize their cash flows, while investors do it to protect the value of their portfolios. Unexpected downturns are by definition unexpected. No one can predict the future with total confidence or know precisely when or how downturns will happen. They can be caused by any number of events, whether it be geopolitical events globally, weather events locally, or any one of a number of causes. One thing that we do know, though, is that eventually things will turn against you, and maybe seriously. The best companies in the world anticipate this and plan against this reality. So some of the many benefits to hedging, and there are several, include locking in the profitability, which leads to greater certainty of earnings. And if your company is a publicly traded company and has smooth earnings, the market tends to value those companies at a much higher rate. And the cost of capital for companies with certain earnings is very low relative to those companies that have volatile earnings. Better returns on equity deployed in your business is an additional benefit that you might gain from hedging. If your earnings are more stable, the capital markets will have a lower hurdle rate necessary, or basically a lending rate for your firm, and it can allow you to deploy your equity much more efficiently. And lastly, I would point out the hedging markets oftentimes make sales and the sales function a lot more efficient. So I'm a history buff, and I love the old-timer stories of the markets and what markets used to be like 100 or 200 years ago. I have an extensive collection of books on the subject and happy to recommend them. When this topic, when we started discussing topics to go over, I was pretty excited about it. So, but very simply, the origins of commodity hedging can be traced back to the to the middle of the 19th century, when farmers and ranchers in the United States began to seek ways to protect themselves from volatile price fluctuations in agricultural commodities. These fluctuations were often caused by factors beyond their control, such as weather conditions and market demand. To mitigate the financial risks associated with these price swings, farmers and ranchers started using forward contracts, which are agreements to buy or sell a commodity at a predetermined price on a specific date. By entering into a forward contract, a farmer or rancher could lock in a price for their commodity, ensuring a certain level of income even if the market price fell. This practice of using forward contracts to protect against price risk is considered the foundation of commodity hedging. And as a bit of a side, we have a picture here of the Chicago Board of Trade. I grew up in Chicago and actually used to work, I spent a summer working at the Chicago Board of Trade. So this is very near and dear to where I'm from in the United States. So as commodity markets evolved and became more complex, so did the hedging strategies employed by market participants. Futures contracts, which are standardized forward contracts traded on organized exchanges, emerged in the late 19th century and provided a more efficient and transparent way to hedge commodity price risk. Futures contracts allowed for greater liquidity and price discovery, making them a popular hedging tool for a wider variety of market participants, including producers, processors, manufacturers, and financial institutions. Today, commodities hedging is a sophisticated and global practice, encompassing a wide range of hedging instruments and strategies. It plays a crucial role in managing risk and stabilizing prices across a variety of commodities markets, including energy, agriculture, metals, and precious metals. Moving on, let's discuss some of the financial instruments commonly used in hedging. These are mainly derivatives, but that shouldn't scare you. Very simply, derivatives or derivative contracts are financial contracts whose value is derived from the value of an underlying asset. The most common derivatives are options, swaps, futures, and forwards. Options give the buyer the right, but not the obligation, to buy, in the case of a call option, or sell, in the case of a put option, an asset at a predetermined price within a specific time frame. Actually, let me go on to the next slide. Yeah, sorry. So options, again, give the owner of the option, or at least the call option example, the right but not the obligation to buy the underlying item at a fixed price and a future date at a fixed date in the future. There are essentially two types of options. We have call options and put options. Call options, if you own them and the underlying asset increases in value, you benefit. The value of your call option increases. Conversely, if you are a seller of a call option and the underlying item increases in value, your you will be a loser in that case. So the important thing to recognize with options is it's the right, but not the obligation to buy the underlying item in the future. And we'll cover that a little more in just a moment here. So we discussed calls. Put options, on the other hand, give the buyer the right, but not the obligation to sell the underlying item at a fixed price and a fixed date in the future. Put options, in order to enter into either a put or a call option, if you are a buyer, you pay an upfront fee, and the value of the put or the call increases or decreases depending on what the underlying item does. Options have 4 different styles of expiration, or sorry, of exercise. American and European are the most common. Equity options in the US allow for American exercise, or sorry, commodity options in the US allow for American style exercise, which means that if I own the option, let's just say a call option, if I own that, I can exercise that call option, which means I can say, hey, I want to buy the underlying thing at my pre-specified price at any point between today and when that option expires. A European option, on the other hand, is only exercisable on a specific day, and it's usually the last day of the term of the option. A Bermuda is just a mix in between. You can exercise it on specific days or times between now and when the option expires. And then an Asian option has a exercise style that's based on the average value of the underlying asset on specific days over the life of the option. Moving on to swaps. Swaps allow counterparties to exchange fixed cash flows for floating cash flows in the future. So if you think about buying a house today, if you get a mortgage that is a fixed price mortgage, maybe you have a specific rate, maybe the interest rate is 6% or 7%. That is a fixed interest mortgage. Alternatively, at least in the US, you can have a mortgage that references some sort of index. And in the US, we tend to use LIBOR. And so if my mortgage is LIBOR plus 3%, the cash flows associated that I make on that mortgage payment move up and down based on where the LIBOR market is. Swaps tend to be focused on the interest rate market, so which is a little beyond the scope of today's session, but we wanted to point it out regardless. Okay, futures. Futures are standardized products that are traded and cleared on regulated exchanges. So the important aspects of futures are, number one, that they're standardized. So for a particular contract month, every single futures contract for that month is the same. And in addition to being standardized, the idea of cleared, unregulated exchanges separates them from our next topic, forwards. But the idea of clearing allows for a third party to be a central clearing agent and provide credit support to the transaction. And this has been a popular topic in some of the client meetings that we had about us providing clearing. And our goal in the future is to provide clearing and credit support to transactions. But it's important to point out that there is no free lunch in finance, and clearing does cost money. There is credit risk that's being taken, and that needs to be accounted for in the price associated with executing. The way that many exchanges or clearinghouses handle the credit risk is that they require an upfront payment called the initial margin that needs to be on deposit with either the clearinghouse or clearing member to enter into the transaction. And then at the end of the day, a daily variation margin is calculated. And so if you are long a futures contract or you own a futures contract and the price of it goes up today, there will be a cash flow into your account at the end of the day that corresponds to the increase in value. Alternatively, if the futures market declines in price, the clearinghouse or your clearing member will ask you to post additional margin. Now, this is the daily variation margin to cover a potential shortfall should the market fall dramatically the following day. Futures can be either financially settled or physically settled. Okay, so we're going to get into the topic of forwards now. And so forwards are the products that are currently available on the Green Tiger Markets platform. Forwards are customized contracts. It's important that they're customized between two parties to buy or sell an asset at a specific future date for a price agreed upon today. Forwards are the most common tool used in global commodities markets to hedge commodity price risk exposure. And forward contracts, just like futures, can either be financially settled or physically settled. And now we've mentioned that twice. And it's important to point out that both futures and forwards have two potential types of settlement. There's a physical settlement of a contract, which results in the physical delivery of a commodity. Then there's a financial settlement style. And in financial settlement, the parties look to a market price or an index as the final price to settle against. If the transaction was entered into at a price above the final settlement price, the buyer will pay the seller the difference between the two prices, and vice versa. An example of a pricing index would be the average of all the 5-minute postings of WESM over the course of a month. But it's very common in commodities markets around the globe to financially settle transactions instead of physically settle them. And so the only thing that needs to happen at the maturity of the contract is a payment from one party to the other. So getting into a real example of an issue where a firm could benefit from hedging is the topic of Cemex and cement in the Philippines. So cement in the Philippines is some of the most expensive in the world. Massive construction projects are being canceled due to the high cost of cement. And we pulled this image straight out of the Cemex earnings report. And the important thing to note is that Cemex has pointed out that fluctuating prices and the availability of electricity and fuels may have an adverse impact on the company's cost and operating results. Increases in electricity and fuel costs, or any interruption to or shortage in the supply of electricity and fuel, could materially and adversely affect the company's business, prospects, financial condition, and results of its operations. So It sounds like this is a candidate that would benefit from hedging and locking in today to gain greater certainty over some of their input costs, notably electricity. So some of the best run companies in the world are active participants in global commodities markets and global derivatives markets. And there's a widely held belief in the Philippines that derivatives are a form of gambling. This opinion is very damaging to the stability and growth potential of the national economy and needs to be reevaluated. In fact, hedging and derivative contracts are exactly the opposite of gambling. It's the fiduciary responsibility of business leaders to remove uncertainty, if possible, or in a cost-effective way, as a mechanism to provide operating efficiency to their companies and stability and continuity to their customers. The best-run companies in the world use derivatives to create certainty. So certainty and creating certainty in the electricity forwards is now becoming a reality. And it's becoming a lot easier and more cost-effective to enter into these hedging products, which create certainty. So when we look at the example of a solar generator of electricity seeking financing, uncertainty in their future cash flows will inhibit their ability to secure a loan or financing for the project. Physical sales agreements can also take a really long time to negotiate and might not result in a favorable price. So when we look at an example of, hey, if I'm thinking about building a 100 megawatt solar generator, or sorry, solar farm that will come to market in 2026, the price of electricity might be lower. It might be higher. You know, in the last 4 years, we've seen monthly prices in the sub 2,000 pesos per megawatt hour. And we've also seen prices in excess of 10,000 pesos per megawatt hour. So if the solar generator is unhedged, they have very unpredictable future revenues. But it's possible for that company to lock in and gain certainty such that that solar generator doesn't care about what the price of electricity is on a day-to-day basis in the Philippines because they've already locked it in. Okay, so we'll move on to I'll just cut to the chase. I know I'm not the sharpest knife in the drawer, so I like to keep things simple. So when we were thinking about putting together this presentation, we wanted to develop a strategy or an acronym to make it easy for you and your firm to develop its own framework for hedging. This can seem like a daunting task, so let's keep it simple. So S, state your intention. I, inspect my options. M, make a plan. P, place an order. L, look at the market. E, evaluate your plan. So state your intention. This is the part of the strategy that comes from the leadership at your company. If management wants to hedge to smooth out cash flows, increase profitability, drive capital costs down, then your hedging strategy needs to take this into account. Are you a buyer or a seller? What happens if the electricity price is higher? What happens if it's lower? How urgent do I need to be? And so when you work with the management, or if you are the management of your company, it's important to lay out at the very beginning what your intention is. And so one of the examples that we used during my time at Goldman Sachs in New York was we would advise companies to hedge 25% of their exposure that's 3 years out. We would advise them to hedge 50% of their exposure that's 2 years out, and hedge 75% of their exposure in the next year, And during the current year, try to get to about 90% hedged. And in the current month, try and get to 100% hedged. Because you don't know if your either supply or demand is going to be higher or lower than your forecasted amount. And so if over time you work into gaining a higher hedge percentage, the closer it is till the delivery, it can allow for you to participate in some of the movements in the market, as well as over time, as your certainty goes up in either your supply or demand, increasing your hedge quantities. So that's S, state your intention. I, inspect your options. This is a part where you look at the market to see what's currently available and possible to execute. In the example of a solar developer, they have several possible ways to hedge their output. The generator might find via a res, a bulk user to buy. The generator could enter into a PSA with an electric cooperative. Occasionally, the ERC runs a renewable energy auction in which several developers have sold some or all of their forecasted production. And DUs like Moralco holds CSPs on occasion. And so those are all ways to hedge your company's exposure. But now it's possible to hedge on GTM using a financially settled forward contract. Okay, M, make a plan. Now that you see that there are buyers in the market and you know that you're a seller and you want to sell 50 or 75 or 100% of your generation, depending on the time period, you can basically put that plan on paper. We've given an example of one already, and then go out and execute it. So make a plan. P, place an order. So if you've decided on your plan of action, you want to get 25% hedged in the third year, 50 in the second year, 75 in the first year, it's now time to execute that plan in the market. And so P, placing an order, is where the execution comes in. So right now in this example, there's a buyer at a price of 5,500 and a seller at a price of 5,900. So you could just hit the bid right now and sell at 5,500, or you can offer someplace under 5,900, maybe 5,700, maybe the middle. Or if you think you could offer 10,000, but the chances that somebody buys it from you at 10,000 are actually pretty low. So we would suggest placing an offer somewhere better than what's offered in the market. If it is your intention to sell, you've inspected your options, you've made your plan, and now it's time to place an order, it's important to be involved in the market. And when it is transacting, to participate. You don't need to do your full volume every single time that the market transacts. But if it is transacting, this is one of the things I learned at the trading desk in Goldman. Hey, maybe I was a seller and the market was selling off. It was incumbent upon me to participate, even though it was a price that was maybe a little lower than I wanted to do. But the chances are that the market would continue going down. It could bounce back, but it might continue going down. And if it went down enough, eventually I'd be out of a job. So it was incumbent upon me to participate. If I had stated an intention and inspected my options and made a plan, it was important to place that order and get aggressive when it called for it, and pull back from the market when the market conditions called for it, which is maybe a good lead-in to look at the market. L, look at the market. So this is where you look at what's going on in the electricity market. I know a lot of companies that are dialed in right now might have a fundamental analyst who is forecasting that supply and demand is imbalanced one way or the other over next month, next week, next year. So it's important to have a view on what you think the market is going to look like. It's also important to look at some of the factors that drive the price of electricity. And so a few of them are, how much does the fuel cost? And so if the price of coal skyrockets again, like it did when Russia invaded the Ukraine, the price of electricity here in the Philippines is going to go up because the price of coal goes up. Weather is another factor that can potentially impact the price. So if there's a typhoon, that could cause the price of electricity to go down quite substantially, and it has in the past in the historical data. So when you're looking at the market, it's important to look at, when we say look at the market, we're referring to not just the Philippines electricity market and what your forecast for the supply-demand balance looks like, but also things like weather and fuels. So let's say the price of coal is falling. You've stated your intention, you want to hedge, you've inspected your options, you've chosen to use the Green Tiger Market's financially settled forward contracts. You've got your plan to get your hedge ratios up to a certain level. You've placed an order, and now you're looking at the market and you're seeing, oh, wow, the price of coal is falling. Or maybe the rainy season is really outperforming. And so those two factors could easily cause the market to sell off. And it's unlikely that, if you placed your offer at 5,700, it's unlikely that anybody's going to buy those. And so maybe it's time for you to get a little bit more urgent and try and sell the 5,500 bid that was there just a moment ago. So that was just a simple example of looking at the market. Okay, evaluate your plan. Evaluate your plan. So your plan was to sell. You stated your intention. Hey, I'm a seller. I inspected my options. I made a plan. I placed an order. I was looking at the market. Okay, time to evaluate. Did I sell anything? If I was trying to sell 100 megawatts and I sold 0, okay, maybe I need to look a little closer on the urgency to executing. If I only sold 25 of 100, that might tell me, hey, I need to be a little bit more aggressive. Ultimately, the market is what the market is. There's not a lot that you can do to influence the market as a market participant. So if you only sold 25% of your desired volume, and your goal was to sell 50%, perhaps you should get more aggressive. Alternatively, if you put your order in to sell your 25% and within 1 second the entire volume traded, perhaps you should be a little bit more conservative on when you do subsequent volumes. So in addition to, hey, did you actually sell anything? Did you sell the amount that you wanted to sell? It's important to look at your hedge and say, hey, I sold and the market went down and my hedge made money, but does this correspond to the actual exposure that you have? So if your firm maybe lost more money on the physical side of the business than the financial hedging offset, it's important to look at, hey, why is that? Did I not, if I only sold 50% of the volume and the price collapsed, I shouldn't expect that just because I quote unquote hedged, that I would completely offset my exposures. So perhaps make adjustments to your price or volume. Okay, so just a little summary of what we just went over. So we went over an introduction to hedging, some of the fundamental concepts of hedging. We discussed some of the financial instruments used in hedging. So remember, that's options, swaps, futures, and forwards. And then we just went over our simple method. State your intentions, inspect your options, make a plan, place an order, look at the market, and evaluate your plan.